Let's break down the components of it, and let's start with the terms, right?
Mm-hmm.
Rate, right? How to, give us that summary there, and I'm gonna put everything on the whiteboard for you all to
Yeah.
look at, take notes, and we're also gonna provide resources as well. There's a link already in the chat going where you can jump on a phone call with Harrison and his team to discuss this product, see if it works for you according to your personal finances. So again, it's running a math problem that we're trying to figure out. That's all we're
Mhm.
doing. All right. So go ahead.
Yeah. So right now, the all-in-one has it's a variable interest rate. It is an interest-only product. So at the end of the day, it is going to be based off of something called the one-year CMT. And today, that interest rate on the CMT is 4.78. Now, that interest rate does fluctuate. Um, and to be more specifically, that interest rate is actually based off of last month's ending interest rate. So as we move forward into the following months, the beginning of next month's interest rate is going to be based off of the end of this month's, and so on. We're actually seeing that interest rate about 20 to 30 basis points lower coming into this upcoming month. So we're slowly seeing that arc downwards.
And you said
Uh,
4.75?
4.78 is the index, but that is not the fully amortized rate.
Correct.
It's just
Correct.
the index. And so the other portion of the interest rate is going to be your margin. And you can choose between a margin of 2.5 all the way down to 4% in increments of a quarter. So 2.5, 2.75, 3, all the way down to 4.
Got it. Okay. That
Each
was
one of
so
those
that's
has its
that's
own.
that's total. That's what gives you your
Yes,
total rate, depending on where you choose
correct.
from as low as 2.5 or as high as 4. Okay.
Yeah. So you
Got
would, if let's say you chose the 2.5 margin, you would take 2.5 plus 478, and that would be your interest rate.
got it.
Each one of those margins, and it looks like someone had a question about what is the cost associated with
Yeah, we'll
this.
get there.
And
We'll get there.
yep, each one of those margins have a cost associated with it. Obviously, the lower the margin, the more expensive the cost.
Okay.
But over time, you'll likely, in most people's scenarios, spend less in interest because it's based off of a lower number. And when rates come down, you're already taking advantage of that lower rate. So it actually feels a little more powering for the individual. There are some strategies to picking a high margin and a low margin, but that's essentially the breakdown of the interest rate.
Correct. Got it. So that's the breakdown of the interest rate. It's an interest only product. And so now looking at the all-in-one, why do they call it that? And let's break down the components of the product. Now that we know
Yep.
it's interest only, and now that we understand how the rate comes to be, it's a variable. Let me put that as well. It's an interest only product, variable. So the rate will change month to month,
Exactly.
or has the ability to change. Sometimes it might stay the same, right?
Exactly. Yeah,
If
that's
there
true.
was no change, right? Yeah, yeah. Okay.
So the all-in-one's terminology really is trying to say, hey, we're taking your checking and savings and we're combining it with your mortgage account. We're creating kind of all-in-one encompassing location for cash deposits, checks from grandma, bonuses, savings, the whole nine yards. And we're pairing it with your mortgage. Most people's largest debt when they own a home is usually their home. And so by combining the checking savings, and again, I'm kind of using checking savings as just one entity itself. But in reality, as an individual earns their money, it's automatically being deposited against their mortgage balance, which is where you see the reduced interest only payment calculation being made. And obviously, that's where you really get into the kind of the infinite banking pay down debt with debt process.
Yeah. So checking account. So when I get this all-in-one loan product, I'm going to be able to go on the computer or on my phone, log in. I'm going to
Yep.
see a checking account, and I'm
Mm-hmm.
also going to see the
The mortgage.
the mortgage, which
Yep.
which will tell me how much I owe at any
Yep.
given time. And within that mortgage is this line of credit function. right? I have that right so
Exactly.
far?
Yep.
Okay.
So, physically when you log in, you're going to see your checking account. Your checking account, more often than not, is going to show a balance of zero. Don't be worried about seeing a balance of zero. It means that the all-in-one's working. As you earn your money, it goes into the checking account. 11:59 every night, it sweeps from your checking into your mortgage balance. So if you owed 300,000 in your mortgage and you had a $10,000 deposit, your balance of your checking will go from 10,000 to zero, and your mortgage balance will go from 300,000 to 290. Let's just say that you only had a $300,000 line of credit. Your line of credit now opened up from $0 in access to a $10,000 in access. You have access to every single dollar you just deposited in there.
Got it. Awesome. So as it relates to the all-in-one loan product, the terms, so far we've got everything covered on this side.
Mhm.
Okay. So now, how do we qualify for this particular product? What are some of the most important things that my audience needs to know or needs to prepare themselves as it relates to their own finances, their credit score, to position themselves correctly and efficiently for this type of product?
Yeah, I'm going to kind of give you a breakdown of two paths. You have primary residence and non-primary residence, investment property.
Got it. So we can get this product on our primary home. That's what it's available for, and
Yeah.
an investment property. Is there a
And
limitation?
second homes, obviously. But primary and second homes are essentially going to be treated similar, but there are some many nuances with it.
Got it.
The reason why I bring up kind of the two separations is that for primary residence and, to a degree, obviously second home, we want to see credit scores at $700 or above. Whereas an investment property, you're going to be seeing it at 720 and above. That's kind of one of the major distinctions between those two.
Okay, so it's just a credit score difference. So for the
Yeah.
primary, we've got 700 or higher,
Yes, sir.
and for the investment property, 720 or higher.
Exactly. Now, the primary allows for 10% down. There is a mortgage insurance component
Okay,
until you get to 20%.
got it. Very similar to your traditional FHA mortgage. Okay,
Yeah, conventional. Yeah, I mean, FHA has mortgage insurance kind of regardless, but
correct.
conventional is going to have mortgage insurance fall off at that 20%
Right. So
down.
something interesting. I don't know if I'm wrong for saying this. When it comes to your traditional FHA mortgage that comes with private mortgage insurance, right? Even when you get to 20%, it doesn't necessarily just fall off. You yourself have to make the phone call and request, and it might take some time, and then it's eventually gone, right? Go through
Yeah,
an
so
appraisal, I guess.
so FHA is a little more tricky in the mortgage insurance world, but in a conventional loan, essentially at 80% loan to value, it would be based off of the original value of the property when you did your loan. Now, you could potentially request for the servicer to order an appraiser and have it go out there on the cost of the individual. But if you're at 80% from your original purchase price, then yes, you can request. It'll automatically fall off at 78% from your original purchase price, but most
Okay.
people aren't going to be going through that, 8 some odd years until it falls off time frame.
Yeah. So with all-in-one, is there that automatic?
Great question. It's actually a one-time cost at closing mortgage insurance, not a monthly recurring cost. So it's just one upfront mortgage insurance premium one
for
time.
for the first year or for
Just at closing, here's your cost for prepaying the mortgage insurance cost. Just a one-time
one
fee.
time? Gotcha. So
Yep.
10% down, and we have a one-time cost.
And that varies based off of credit score, like almost every
Correct.
other loan program does as well. And we can kind of dive into that here shortly if we need
Yeah.
to.
So one-time cost of mortgage insurance up front. So it's paid up front, or is it paid by us, the buyer, or the person that's refinancing, or is it put into the loan itself?
So, also great question. As the buyer, you would pay it upfront from your individual pocket. Now, in
Got it.
the form of a refinance, it could potentially be wrapped into the product, just depending on how much available equity they have.
Got it. Got it. Yeah. Okay. Very cool.
That's for primary residences, 10% down. For second homes, it's 20% down. And
Okay.
for an investment property, it's 25.
Second home, 20%. So that would
Mm-hmm.
mean no mortgage insurance on the second.
Correct.
Same with 25% down on the investment. No mortgage.
Correct.
25% down. Okay. Interesting. Now, give us an example here. Let's say I have a property that is worth 500K. I got a $300,000 mortgage on it. If I refinance, well, no, let's do one where all I have is roughly, close to that 10% available.
450.
Yeah. So 500K, I owe 450, or say slightly less, to refinance into an all-in-one. Mortgage insurance would be required until I reach the 20% guide.
Well, I mean, yeah, at closing, you'd pay your mortgage insurance, and you would never need to pay it again.
Once.
Yep.
Right. And so how is that mortgage insurance fee calculated? Is it based off of the amount I'm refinancing or the value of the property?
Great question. So there are a couple components are going to be based off that. Obviously, it's going to be based off of the loan amount, and we're going to base it off their credit score and what their final loan to value is going to be. So there's a matrix that we have that, depending on if your score is 720 and above, and one thing to note, that if you are between 80 to 90%, you do need a 720 credit score. That is the only time in it that we're going to need to see that on a primary residence.
Got it. If you have only 10%
Correct.
available equity. So that's required. Got it. All right.
Correct. So if you take 500,000 and you multiply it by 90%, essentially you're going to be at a $450,000 loan amount. And depending on what that individual's credit score is, if it's kind of on that higher tiered end, then their one-time mortgage insurance cost is going to be slightly higher than a 0.5% one-time fee.
Of 450.
Of 450.
4,500
And
bucks.
that's, pardon me?
So that'd be like $4,500 roughly.
A 0.5% of 450 would be like 2,250. Yeah.
Yeah, my bad. Half of that. So
Yep. Yeah.
so
No, I probably said it confusing.
yeah. So 2,250. If we were comparing that to someone getting a regular mortgage, paying a monthly mortgage insurance payment in just 1 year, it'd be way more than that number.
Yeah, I mean, it's possible. It's certainly possible that it could be more than that. But I mean, at a 10% down, it's possible it'd be pretty dang close. I mean, that's the hard part that sometimes people get lost in when thinking about this product, is what is this looking at physically right now, but what does it do over the life of the loan compared to what I may already be in? That person in that loan may be in a 6.25% interest rate. Great, they're going to spend 100% of what they borrow in interest, a little more actually. And in just the first 5 years, they're going to spend something like 27 total percent. So in the first 5 years of that loan, they're going to spend about $121,000 in interest. If we're able to have that person pay their home off in 5 to 8 years, and they only spend $150,000 in interest, now great, more than in the first 5 years, much less than in the life of the loan. What is an extra $2,200? Okay, great. I was going to spend 450 grand. I'm now going to spend 165,000. Great. I would pay $2,000 to save $240,000 every, over that time frame.
Got it. And there's more benefits we're not discussing in terms
Yes.
of being in that liquid position for the unexpected.
Yes.
If my goal is to pay my home off in, say, 5 to 8 years, right? Let's just say that's, I know there's disagreements on whether you should or whether you shouldn't pay off your home sooner. What's nice with the all-in-one is, let's say you weren't necessarily bought on paying off your home faster, you could be doing it automatically and then pulling the money out to, say, do another project. So it's like, even if you didn't want to pay off your home fast, it's going to get paid off faster. Just
Correct.
because of how you've unlocked the equity in that home while making your investments or making other moves with the money that's in there. So instead of having your income come into a checking account and service a mortgage payment, and then your cash flow is going to investments, right? That's the camp that says, don't pay your mortgage off because it's at this low interest rate. We can go earn a higher rate of return over here with your cash flow.
Mhm.
What we're discussing here is the opportunity of being able to do both.
Both.